Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 14. A study by a mutual fund has revealed the following data in respect of three securities. Security A, B and C along with the standard deviation is given, which is nothing but the risk of the securities, and correlation with index, which is nothing but market portfolio, 0.6, 0.95 and 0.75. Now the standard deviation of market portfolio, which is here the index, is observed to be 15%. So standard deviation of market portfolio is also given, market return. Now what is the sensitivity of returns of each stock with respect to market? So sensitivity of return of each stock is with respect to market is nothing but the beta of each stock. So beta can be found out by covariance divided by variance approach or the simple regression method also. Here, since we know the correlation coefficient and the standard deviation of stocks and of the securities and market return, we can go ahead with the covariance approach. So covariance by variance, which is nothing but the standard deviation of A or the standard deviation of respective stock multiplied by the standard deviation of market return multiplied by correlation coefficient of the stock with the market return divided by variance of the market return. Now variance is nothing but standard deviation square. So in the denominator and the numerator we have standard deviation of market return, which if we eliminate, then the revised formula will be standard deviation of the stock multiplied by correlation with the index, here correlation coefficient, divided by the standard deviation of market return. So if we apply, we can get the beta values. So that's what ICAI has followed. 20 multiplied by 0.6 divided by standard deviation of market return 15, 0.8, 1.14 and 0.6. The second requirement is what are the covariances among the various stocks. So we need to find out the covariance of each stock with the other stock. So here we have the formula to find out that. So beta of stock X or stock A multiplied by the beta of stock B multiplied by the variance of market return will give us the correlation between two stocks. Here we have the correlation coefficient with the market return, but we require covariance between two stocks, so this formula will be the apt one. Now substituting in this, we will get covariances between the stocks. Now covariance between itself will be the variance of that respective stocks. So covariance of A with A will be variance of A. So since we have standard deviation square will give us the variance. So 400 for covariance of A with A, and B with B is 324 and C with C is 144. Now covariance of AB is nothing but beta of A multiplied by beta of B multiplied by the market's variance. So 0.8, which is the beta of A, and then 1.14 is the beta of B multiplied by 15 square will give us 205.2. Same case goes with AC and BC. Using this we can create this covariance matrix, so which is nothing but A with A we got 400 same, then A with B is 205.2, then A with C is 108. B with A is nothing but A with B both are same, so same 205.2. Then B with B we have 324. Same way the covariance matrix. Now the third requirement is what would be the risk of portfolio consisting of all the three stocks equally. So here they are asking the risk of the portfolio, and in the previous questions we have seen risk of portfolio wherein only two stocks are involved, so we followed that a plus b the whole square approach. Here the same approach we can follow, but three stocks are involved. So mathematically this will be the formula to find out. A plus b plus c the whole square will give us a square plus b square plus c square plus 2ab plus 2bc plus 2ca. But as we have seen previously also, we have to multiply with the correlation between those securities. So here 2ab will be multiplied with the correlation of a and b, then 2bc with correlation of b and c, then 2ca with correlation of c and a. Now uh, substituting this with our formula, so a signifies the weight of a multiplied by standard deviation, and b will be weight of b multiplied by standard deviation, and c will be weight of c multiplied by standard deviation. Now if we expand 2ab multiplied by the correlation, we can bring out the weights and then make these values as covariance, because covariance of AB is nothing but standard deviation of A multiplied by standard deviation of B multiplied by correlation of A and B. Because we know the covariance of all the three factors, that's why we are taking this. Instead we don't know the correlation of A and B, so taking this weights out, that's what ICAI is given here. If we see clearly, since they have told the weight is equal, so which will be 0.33 or 1 by 3. So here they have taken 1 by 3. So in the first case, weight of a square, so 1 by 3 the whole square, then standard deviation of a square, which is nothing but the variance of a, and we know the variance of a here, which is 400. Same case with b square, then c square, then 2 into covariance of AB multiplied by weight of A. Same case here, 2 into covariance of AB multiplied by the weight, then 2 into covariance of B multiplied by this, and then 2 into weight of C. Here as you can see, weight they have squared because weight of A multiplied by weight of B, both are equal weights, that's why 1 by 3 the whole square. After substituting this, we are getting a risk of 200.244 as the total risk of the portfolio. Here also, if we notice, the risk of A is 400, then risk of B is 324, and then the risk of C is 144, which if we do the weighted average method, so we'll get 289.33 as the weighted average risk of the portfolio, but which is wrong. We are getting a value of 200.244. Even as we have discussed in our previous videos, since diversification plays a major role in reducing the risk of the portfolio, here also same thing happened. If we take the weighted average risk of the portfolio, it is giving me more risk, but actually because of diversification, our unsystematic risk portion will get reduced. So compared to the weighted average risk, our risk of portfolio is 200.244. So the reduction in risk is mainly because of diversification. Going up with the next requirement, what is the beta of the portfolio consisting of equal investment in each stock? They are asking beta of equalized weighted average weighted portfolio. So we can directly take the weighted average approach, because beta is the sensitivity towards the market return. Here it is more towards the systematic portion, wherein it will get multiplied with the market return, which is the systematic portion. So here the diversification thing will not apply, because it is just the sensitivity of the stock towards the market return. So beta is a value of sensitivity. So we can directly multiply with the weights and then calculate the weight, so which is nothing but the weighted average. Even if some weights are given, we can multiply it with the weights and then we can arrive at the value. So equally, since they have given equally weighted, the addition of all betas divided by 3 will give us the beta of the portfolio. Now this next requirement is, what is the total systematic and unsystematic risk of the portfolio in 4? They're asking in case of 4, like using the 4th value, find out the systematic risk and unsystematic risk and even the total risk. We have already calculated the total risk, which is 200.244. So we just need to find out the systematic risk, and if we reduce it from the total risk, we'll get the unsystematic portion. Systematic risk is nothing but beta of portfolio multiplied by market variance. So 15 square will be the 15, they've given us the market portfolio standard deviation, square will give us the variance, multiplied by beta of portfolio squared will give us the systematic risk, which is 161.302. Reducing it from the total risk, portfolio risk, 200.244 will give us the unsystematic risk, which is 38.942. Thank you.